I was sitting on my porch the other day, just watching the weather change, and I started thinking about how we experience the economy.
Mhm.
I mean, us, regular people, investors, business owners. In peacetime, or at least when things are relatively calm, the economy, it feels a lot like the seasons.
That's a very um, pastoral way to start a deep dive on economics.
Yeah.
But I see where you're going. There's a rhythm to it.
Exactly.
Yeah.
You've got your spring, that expansion phase where everything's growing, green shoots, optimism. Then you hit a summer peak, things get a little too hot, maybe.
Yeah.
Then they cool down into an autumn contraction, and eventually you hit winter. A recession, maybe? But even in winter, spring is coming back, it's cyclical.
It's predictable.
Yeah, predictable. You can just wear a coat and wait it out.
And you're right. Statistically, that is the normal heartbeat of the global economy.
Yeah.
Innovation happens, confidence builds, central banks sort of tweak the dials.
Raising rates a quarter point here, lowering them there.
Exactly. And the cycle continues. We build our entire financial lives around that rhythm.
But today, we are not talking about the seasons. We are talking about what happens when a Category 5 hurricane just smashes into the calendar. We're talking about war.
Mm-hmm.
We're doing a deep dive into this really fascinating and frankly pretty sobering piece of research called War Economy Chapter 4, From Stability to Shock.
Right. And looking at this source material, which is giving us a really crucial snapshot of the landscape here in early 2026, the goal isn't just to look at headlines. We see those every night.
Sure.
We want to get under the hood, understand the mechanics of what happens to money, to trade, to stability when that conflict switch gets flipped.
Because it really feels like the rules just change overnight. One minute you're worried about a Fed meeting or quarterly earnings, and the next minute, well, the board game just gets flipped over.
It does. If peacetime is all about predictable patterns, wartime is defined by what some researchers call structural uncertainty.
Structural uncertainty.
It's the difference between knowing it might rain tomorrow versus not knowing if the sky's even going to be there. It's not just risk. It's the inability to calculate risk.
I love that phrase because it sounds so academic, but it feels terrifying. So let's unpack this. Before the storm hits, we have this normal cycle. And the source material makes this really interesting point about the glass house we've built.
Ah, yes. The just-in-time supply chain.
That's the one.
This is the backbone of the modern world. And to understand why war is so disruptive, you have to understand how fragile this baseline actually is.
We hear just in time all the time. It's a buzzword. But what does it actually mean? Why is it a glass house?
Well, think of the global economy as a lean athlete, like an Olympic sprinter. Zero body fat. Companies do not want to pay to store mountains of inventory in warehouses.
It's expensive, ties up cash.
Exactly. So they design these systems where parts arrive at the factory literally hours before they're screwed into the car or the computer.
So the tires arrive at the auto plant at 9 a.m. for the car that's being built at, 11 a.m.?
Precisely. It keeps costs down, it keeps prices low for you and me at the store, but it relies on one massive, towering assumption.
That everything runs perfectly.
Open borders, safe shipping lanes, perfect timing. It's a beautifully choreographed dance.
A carefully balanced ecosystem.
Yes. And as the source notes, it works beautifully until it doesn't. Because that efficiency comes at the cost of resilience. When you have zero buffer, you have zero room for error.
We stripped out all the shock absorbers to make the car go faster.
That's a great way to put it.
Okay, so let's talk about the moment the car hits a wall. The immediate shock, the drums of war start beating. What is the very first thing that happens in the financial machinery before a single shot is even fired?
Panic.
Eh.
Pure and simple. It's psychological before it's mathematical. Investors are human, and when the threat level rises, they engage in panic selling. They just dump risk.
And they run somewhere else.
They run toward what we call safe haven assets.
I saw a note in our research about this, specifically about gold. It seems like gold is the doomsday prepper of the investment world.
Gold is the classic example. It's almost Pavlovian at this point. War starts. Gold goes up.
But why?
Because it's physical. It doesn't rely on a government's promise to pay, and it doesn't rely on a supply chain to exist. But it's not just gold. You see immediate spikes in commodities: oil, natural gas, wheat.
The things you actually need to survive.
And to move armies, yeah.
And this brings us back to that term you mentioned, structural uncertainty, because prices fluctuate all the time. Why is this different from, say, a bad harvest raising the price of corn?
That's a crucial distinction. A bad earnings report from a big company or a drought That's a temporary blip. We can calculate that. We can say, okay, corn is up 10%, we adjust the model.
Right.
But a major conflict, that places a fundamental question mark over the future. It changes how investors behave for the long haul because they can't calculate the risk anymore. And when you can't calculate risk, you don't invest. You freeze.
Or you flee.
Or you flee.
And that fleeing money is leaving that glass house of efficiency we talked about. This is where it gets really interesting to me. The breakdown of the supply chain. We know just in time is vulnerable, but I think people assume it breaks because, a factory gets bombed.
The movie version of
Duh.
it. The explosion.
Yeah.
And that's part of it, for sure. The physical destruction ports, roads, factories, that's the most obvious disruption. If the bridge is gone, the truck can't cross. But the source highlights that it's multifaceted. It's often the invisible things that break the system first.
Invisible things. Like what?
Logistics and bureaucracy. The boring stuff that makes the world go round.
Yeah.
Take shipping. If a conflict breaks out, it's not just that ships can't go there. It's that insurance premiums for those ships go vertical.
Oh, right. Maritime insurance, of course.
Exactly. So suddenly, it's mathematically impossible to afford to send the ship, even if the water is technically clear. The risk premium makes the voyage bankrupting before it even starts.
So the ship just sits in the harbor, not because of a blockade, but because of an actuary's table.
Precisely. Or it takes a massive detour, adding weeks to delivery time. Then you add customs delays, labor shortages. The just-in-time system collapses because it can't handle a 3-week delay. It wasn't built for a 3-hour delay.
And the consequence of that isn't just my package is late.
No. The consequence is resource scarcity. We're talking about raw materials not showing up, components for electronics, ingredients for pharmaceuticals, and most critically, energy and food security.
Right.
When those supply chains snap, you get immediate, painful price spikes that hit everyone, regardless of where the front line is.
That's the scary part about globalization, isn't it? You don't have to be in the war zone to feel the shockwave. You feel it at the gas pump, at the grocery store.
Everywhere.
Okay, let's move past that initial panic. The source material has a section called The Deep Scars of War. This is what happens after the smoke clears a bit.
This is where we move from psychology to hard data. And the data, particularly from the Center for Economic Policy Research, it's really sobering. It puts a number on the destruction.
Yeah, I was looking at these GDP numbers. They are staggering. What does a 13% decline actually mean in real terms?
So the research shows the average decline in real GDP, that's the total economic output of a country, is 13% over a 10-year period after a war.
13%. To put that in perspective, during the 2008 Great Recession, U.S. GDP fell by about 4%. And that felt like the end of the world.
It did.
A 13% drop is a agree. That's depression. It's a hollowing out of an entire economy.
It's massive. And remember, that's just the average severe conflicts. You're looking at over 30% reduction within just 5 years. The source uses Ukraine as a real-world anchor. Their GDP fell by nearly 30% in 2022 alone.
A third of the economy just vanished.
Vanished. And it's not just that people stop buying things, it's that the money stops flowing in to build things.
The investment dries up.
Precisely. Real investment falls by about 13%. Exports fall by around 12%. I mean, who wants to build a new factory in a war zone? But here's the double whammy for the government.
Let me guess. You're making less money as a country, but war is the most expensive thing you can possibly do.
That's it, exactly. Government revenues plummet down about 14.5% on average. Tax revenue dries up. But military spending stays high, or skyrockets. You can't cut the budget when you're fighting for survival.
So you have a massive deficit. And how do you pay for it if investors are fleeing?
That brings us to the inflation trap. When you can't borrow and you don't have tax revenue, governments resort to what's called monetary financing.
Which is a polite economist's way of saying...
turning on the money printer.
Right.
They print money to pay the soldiers, to buy the weapons. And the stats on this are incredibly specific. This leads to consumer price levels rising about 62% over a decade. The money supply itself increases by 67%.
So you have an economy that's 30% smaller, meaning there's less stuff to buy, but there's 67% more cash floating around chasing that stuff.
That is a textbook recipe for hyperinflation. It destroys savings, it wipes out the middle class. But there's a counterintuitive fact here that really stood out to me.
Okay.
Usually in Econ 101, we learn that when a country's currency crashes, it's actually good for their exports.
Right, because their goods become cheaper for the rest of the world to buy. A weak dollar makes American cars cheaper in Europe, so we sell more cars.
It's supposed to be a self-correcting mechanism. In peacetime, yes. But in war, This rule breaks completely.
Why not? That seems like the one silver lining.
Because to make things, to build that car, you usually need to import something first. Machinery, fuel, raw materials. And since your currency is worthless, those imported goods become impossibly expensive.
Ah,
So you can't even manufacture the cheap goods to sell. You're stuck. You lose the export boost and you get the inflation.
that is just a brutal cycle. The economic machinery just grinds itself into dust.
It is a persistent bleed. And that persistence really sets it apart from other types of disasters.
It's the perfect segue, actually. The source material compares war shocks to other things like the COVID pandemic. I think for a lot of us, COVID is our main reference point for global disaster.
It is for this generation, yeah. But they are structurally different. Think about speed.
Yeah.
During COVID, the S&P 500 dropped 34% in just 33 days. It was a cliff. It was terrifying.
I remember.
But because the infrastructure wasn't destroyed, the factories were still standing, the roads were fine, we just paused. The potential for a V-shaped recovery was there.
And we did bounce back pretty quickly, all things considered. But war doesn't have a V-shape.
No, war is a slow, deepening wound. The initial GDP drop might look small, maybe 3%, but the damage deepens over time. We're talking 16 to 18% drops a decade later. It doesn't bounce, it drags along the bottom.
The source also mentioned a distinction between types of wars, civil wars versus wars between countries. I would have assumed a massive war between two big nations is worse for the economy, but the data says otherwise.
Surprisingly, yes. The research found that civil wars or interstate conflicts actually cause more profound, lasting damage.
Why is that?
It's because the conflict is everywhere. It's not on a distant border. It tears apart the legal system, the social fabric, the internal trade networks. Neighbors stop trading with neighbors. And grimly, the source notes that the loser of the conflict suffers significantly larger and more persistent losses.
That makes a grim kind of sense. But there's one point in the source, I think from Goldman Sachs, that I found almost cynical, this idea of market immunity.
Ah, yes. This is fascinating. The argument is that markets can actually learn to price in risks. If there's a shock and then another similar shock, the market reacts less violently the second time. It develops a callus.
So the market just gets used to war. That sounds incredibly cold.
It is cold, but the market is an information processing machine. It's not emotional. Unless, and this is the huge caveat, the event fundamentally breaks the growth engine or the supply chain.
Oh.
If it's just political tension, the market can shrug. If it stops the oil from flowing, the market crashes. It cares about cash flow, not headlines. It learns to live with the noise as long as the signal to money keeps moving.
That is both comforting and terrifying at the same time.
Welcome to economics.
Yeah.
It's the study of how the world is, not how we wish it would be.
So if we know the storm is coming, or if we're living through the ripple effects of one right now in 2026, what's the path forward? How do economies rebuild? We always hear about the Marshall Plan, the post-WWII boom. We assume after the war comes the boom.
The source material is very honest about this. Rapid recovery is not the norm.
Yep.
We love the story of the post-WWII boom, but that is the exception. Usually, rebuilding is incredibly difficult because of financial frictions.
Financial frictions. Break that down for us. It sounds like sand in the gears.
That's a good analogy. Imagine you want to rebuild a factory. You have the plans, you have the workers, you go to the bank for a loan, but the bank says your collateral was that building that just got blown up.
Right.
Or they say, we don't know if the currency will be worth anything next month, or we can't enforce a contract because the courts aren't fully open.
So the credit just dries up.
Completely. Without credit, you can't buy materials, you can't pay workers, the plumbing of the economy is broken.
So you're stuck in neutral. That explains why that GDP drag lasts for a decade. But the deep dive does offer strategic considerations. It outlines how economies can build immunity, moving from efficiency to resilience.
Yes. This is the emergency fund concept for a whole country. The first step is diversification. You can't rely on a single point of failure. If all your microchips come from one island and that island gets blockaded, you're finished.
And I noticed a push for domestic capability, which feels like a total reversal of the last 30 years of globalization.
It is a reversal. It's a shift in philosophy. It's the ability to produce essential goods at home. It's less efficient, it costs more, but it buys you survival. It's paying an insurance premium so that when the supply chain breaks, you don't starve.
It's the difference between just in time and just in case.
Exactly.
And what about the people in charge? The central banks, what can they actually do?
They have the hardest job in the room. The source emphasizes adaptive policies. They have to fight that war-induced inflation without crushing the little economic activity that's left. It's like performing open-heart surgery during an earthquake.
So, to summarize where we've been, we started with the seasons of peace, this predictable cycle we take for granted. Then we saw how the glass house of just-in-time efficiency shatters.
We tracked the immediate flight to safety gold, safe havens, and the breakdown of logistics, where invisible costs like insurance freeze trade.
And we looked at the scars, the GDP drops, the inflation traps, and the slow, grinding recovery.
And finally, this pivot we're seeing now in 2026. This move away from pure efficiency toward durability, paying a little more now to ensure we survive later.
It really changes how you look at the news. You realize a conflict isn't just a political event, it's a rock thrown into a pond, and those ripples, the price of gas, the availability of parts, the value of your retirement account, they touch everyone.
That is the key takeaway for me. We think of war economies as something that happens over there. But in a globalized world, we are all part of the same circuit board. When one part overheats, the whole system feels it.
Which brings me to a final thought. We talked about that Goldman Sachs point that markets can develop immunity.
Right, the callus on the hand.
Here's my question. If the financial system gets used to war, if it gets good at pricing in the destruction and just shrugs it off, does that make us stronger? Or does it just make us numb to the warning signs of the next big one?
That is a very dangerous question. If the alarm bell rings so often that we stop checking for smoke, we might not realize the house is on fire until it's too late.
Something to think about. Thanks for joining us on this deep dive into the hidden machinery of the war economy. Stay curious, stay resilient, and we'll catch you on the next one.